Assalamualaikum warahmatullahi wabarakatuh. Good evening, everyone. Have you ever wondered how a company goes from being a privately owned to having its share traded by millions of people around the world daily? It's all happened through the stock market, which is divided into two fundamental components, the primary market and the secondary market. In the next 5 minutes, we will explore how these two markets operate, how they differ, and how they work together in a perfect synergy to fuel the global economy and help business grow while allow individual investors to build wealth. Let's dive in. Primary market. Let us start at the very beginning with the primary market. You can think of the primary market as the first-hand market. This is the place where a company issues new securities, such as a stock or bond, and sell them directly to public for the very first time. The most famous event in this market is an initial public offering or IPO. This is a landmark moment for a growing company by going public. The company can raise massive amount of capital directly from institutional and retail investors. There are two key characteristics you must remember about the primary market. First, the pricing of the fiction before the share are sold. The company and its financial officer, known as underwriter, set a specific fixed price for the stock. This price does not fluctuate on a minute-to-minute basis. And the two is the destination of the fund. When you buy share in an IPO, your money goes directly into the company bank account. This capital is then used by the company to build new factories, hire talent, or expand their operation. Essentially, the primary market is where new capital is created. Secondary market. Now, what happened after the IPO is over? This brings us to the secondary market, which you can think of as the second-hand market. Once a company share are officially listed on a public stock exchange, such as the Indonesian Stock Exchange or IDX, or the New York Stock Exchange, the primary market closes for those shares and the secondary market takes over. Here, the dynamic change completely. First, the trading is purely between investors. If you buy 100 shares of the company today on your mobile trading app, you are not buying them from the company itself. Instead, you are buying them from another investor who dedicated to sell. The company is not directly involved in this transaction and they do not receive any of the money. And the second, the price highly dynamic. Unlike the fixed pricing of the primary market, price is changed every single second. They are driven entirely by the force of the supply and demand. As positive news comes out about the company, demand structures and the price goes up. This fluctuation gives investors the opportunity to achieve capital gains, buying low and selling high. And so the secondary market is where liquidity and continuous trading happen. For key compares, so to make this concept even clearer, let's look at this compares double summarizing the key of the difference. The practice involved in the primary market, the transaction is directly between the investor and the issue company. The secondary market is a strictly investor to investor. Pricing, the primary market feature predetermined fixed price set by the company and underwriter. In contrast, the secondary market price fluctuates constantly based on the market demand. Flow of money goes directly into the company's reserve in the primary market. In the secondary market, money morally moves from the pocket of the buyer to the pocket of the seller. Trading window, the primary market is open for a very limited time, specifically during the IPO subscription period. The secondary market, however, is highly flexible. You can trade any business day during market hour. Fees. Buying during an IPO is typically free of brokerage commission, while trading in the secondary market incurs small transaction fee and tax from the brokerage app. Alright, maybe just only that I can explain in here. I'm sorry. This is an synergic ecosystem. To wrap up, it is crucial to understand that the primary and the secondary market are not competitors, instead they from highly synergistic economies. Without the primary market, companies could not raise the capital they need to innovate and scale. But without the secondary market, investors would be reluctant to buy share in the first place because they would have a quick, reliable way to sell the share and convert them back to the cash. Together, they keep the financial world spinning. Maybe just only that what I can explain in here, more or less I apologize. Thank you for watching and